GetCrack. Wake up, motherfucker.
The USDA's Prospective Plantings Report plays a crucial role in shaping market expectations for the upcoming crop year. Every year on the last trading day of March, the USDA releases estimates based on a survey of farmers showing the intended acreage for principal crops. This year's report is vital in confirming many analysts' assertions of a sharp increase in corn seedings this spring, with some estimates as high as 95 million or more acres, which would be up from 90.6 million acres of corn in 2024. With the global stocks-to-use ratio of corn the tightest since 2013/14, it is imperative the United States grow an adequate crop to meet demand. And for many producers, soybean and cotton prices are a losing proposition. Should USDA's acreage estimates fall outside of trade expectations, a quick repricing event can occur in a last-ditch attempt to sway acres prior to spring. Farmers will also have a keen eye on USDA's quarterly stocks estimates, showing how much of each product was in the U.S. as of March 1st. The quarterly stocks portion of the report is the quickest way to see abrupt changes to agricultural balance sheets, as it has often shown we simply have more or less product than we thought.
Over the past 4 years, experts warned of stagflation, but it didn't happen. And after months of optimism over the outlook for a U.S. economic soft landing, the prospect of it has resurfaced. Stagflation occurs when growth stalls, inflation persists, and unemployment rises.
We cannot accept high rates of inflation as a permanent fact of American life.
In the 1970s, the Fed struggled with this as middle-class families dealt with soaring prices for gas and groceries, while many also were hit with massive layoffs and job cuts. Today's current policies are adding an extreme level of uncertainty to the economy, as everything from tariffs and DOGE cuts to government jobs and funding to mass deportations are heading up the list of concerns. Though CPI rose 0.2% in February, which was down significantly from 0.5% in January, this report does not yet reflect the impact of these policy changes, thus the concern moving forward. According to Ernst & Young, the odds are uncomfortably high that we enter a stagflation environment because there seems to be an intent to pursue tariffs to their full extent. And this comes at a time of much weaker than expected economic data that has rattled investors, including a projected negative GDP for the first quarter, according to the Federal Reserve Bank of Atlanta.
Yo, what's up? What's up? It's March 19th, 2025. And yeah, we made it through Powell. Everything looks swell. Swell. I don't know about the stagflation stuff, but hey, keep that in your mind. Let's see now. So Bitcoin went through 86,000 just after market close on the NYSE and NASDAQ. Okay. So I'm going to be watching this one, see how much more we can go here. SPY back at this resistance level after dropping yesterday for who knows what reason. I guess people just wanted to sell just because they wanted to. And let's see, SPY went down to 559, back up to 568-ish. Okay, it tried to get to a high of 570. Remember, we need to get to around 580. Okay, that's where the gamma level is, where we are. All right, so that's what we're looking for. So let me put back up the chart here, and you can see where we're at here. I'm looking at this line. So we tried to get through it again. We went through it on Monday. So that area is where you should have sold. Okay, a little bit. You could have got back in again or just held or whatever. I don't know. If you didn't sell, then come back here. We got to get through this into the end of the month, and that'll be the end of the quarter. Okay, I have no clue what other news there will be now. Powell is done. We won't have anything until PCE, and I don't think that'll be a surprise at the end of the month. And that's the last day of the quarter. Let's see. Yeah, about the 28th. So one more day after that on Monday, the 31st will be the last day of the quarter of trading. And we're done here, okay? And that's we have a limit of how low we can go, and then how high we can go. We've been in this range. This is kind of set by the let's see. I talked a little bit about the JPM collar. I don't think I talked about it too much. I do have a video I could play. Maybe that thing mentions it. Let me see. I wasn't planning to play this video, but since it reminded me about the JPM collar, I might well bring it up. Let me see. Let me see if I saved it anywhere here. It might have been on my other disk. Okay, well, I'll look for it. Okay, when I play another video later on. All right, so again, Bitcoin here at 86,000 is pulling back now. So after the close, we went over and up, and then we're back down. So we gotta wait and see if this holds for the rest of the week. Okay, this is we'll have options expiration on Friday for stocks, equities, bonds, futures, and then Bitcoin will have its quarterly expiry next week. Okay, next week. So it's always the last Friday for Bitcoin, Ethereum. We also have Solana now has a futures market too. So add that with it. It's just started trading. So we have 3 cryptos on the futures market right now. Okay. Let's see. That's it. Let's see what the QQQ was. QQQ. Same thing, similar thing here. A little bit weaker. You can tell a little bit weaker, but similar performance, right? And if you look here, if you look closely for the SPY, you can see kind of, yeah, a little, yeah, it almost collapsed yesterday, right? But since we don't have PAL, it was just like NVIDIA's keynote, because they have a conference for graphics going on this week. So Jensen Huang was talking, but the market was already down before he talked. So there was just nothing there that I cared about. There was just nothing there. So if you look at NVIDIA, yeah, nothing. It's just dancing in this area. NVIDIA is dancing at 118, so I didn't care. MSTR just bouncing back and forth, made a new high today. Very good. So I'm going to see if it can hit 320 something again. Tesla had bad news yesterday, but now we're back testing this area of 240 for Tesla TSLA. The bad news is because China's kicking their asses. So like I was talking about, BYDDF, the Chinese electric car maker, they have developed technology that can charge batteries in 5 minutes. So 5-minute charge right there. Okay, so that's it. That's what I've been saying all along, to buy this stock way back when, and we are making it now. We're breaking out of this range. Well, I mean, it's too late to be chasing this. I think it's going to have earnings, right? On Monday. Okay, Monday earnings. Tencent had earnings. Didn't do much. It had good earnings, but didn't do much. But yesterday, Tencent Media Group did have earnings. It was up 17% or something like that, 15% at most. Let's see. Yeah, 15%. Okay, that's good. All right. So if I look at that, it's right by this line. Yeah, I don't know. It's a good time to buy, add. So if you've been buying this before, you don't need to worry. But if you're new to buying or you want to add to the buy, yeah, I probably would wait. Okay. Let's see what gold's doing. Okay, gold miners. Yeah, nothing much today. Nothing much today. So even with PAL and all that, so I can't say if I want to add to any of my gold positions or silver positions or anything right now. So I don't think that's enough for me to tell. It is strong though. I'll give it that. So maybe I'll see what happens in the next 2 days to close out the week. But TME for Tencent Media Group, yeah, it looks good. TME, yep. This chart looks beautiful. Another one was TIGR Up FinTech. This thing, yeah, they had earnings like 2 days ago, I think. Let's see. No, it was yesterday. All right, it was yesterday. 21%. Not bad. Okay. And then it's been doing this. Okay, not bad. This one is another one where I have to consider if I want to add or yeah, I don't know. So TIGR up fintech, and their competitor is Futu, FUTU. Both of them are pretty much like the Robin Hoods of China. So if all the Chinese are buying their stock, they're going to start chasing it. Then this thing will break out. These two guys will break out. I think that's it. Baidu had something about, I think I mentioned it already, about AI, but maybe I didn't. Did I talk about that? Dang, I don't remember. Let's see, Baidu. Did I? Well, if I did or yeah, I think I did. I talked about Ernie, so they called their AI Ernie. All right. Okay, Eric said first brokerage. You probably should get a Fidelity. Okay, that's one. At least one Fidelity, and then one Internet Active Brokers, one Robinhood. Okay, and I saw like all seeing guy talking about Schwab is okay because they bought out what was it, TD Ameritrade, but a lot of people have been complaining about when they integrated with TD Ameritrade. Like, I don't know what's going on there. Hopefully it's still okay to use TD Ameritrade after Schwab bought them out. But yeah, Schwab is another one. But the very first one, okay, you got to get one Fidelity. But if you want to do options, it's way easier if you just start with Robinhood. Robinhood doesn't care. So like the last weekend stream I did, all seeing guy was complaining like with White John Galt. He was like, oh man, I can't get, like, I gotta do all these applications to get my options. Okay, you want to start trading options right away without them testing you or requiring you to sign all kinds of papers and things. You just go to Robinhood. They don't care. They don't care if you lose money. So they don't care if you know what you're doing or not. They'll let you trade options. So if you want to blow up something right away, and Robinhood has like certain features that are quite useful. I mean, I know people hate it because of GameStop and all that stuff, but for certain cases, yeah. And also they'll give you 4 to 5% interest on your cash. Like, yeah, Fidelity does a pretty good job, but it's not 4 to 5 automatically, depending on the account. The size of the account, like Fidelity requires you to have a big amount of money in your account for them to give you the highest interest rate when you don't have any, when it's just cash. So when you're just cash, it'll automatically set it to a money market fund. And for Fidelity, they just give me like 3%, not like the 4 or 5 if I have it in my Robinhood. Okay, Robinhood is very generous. They don't need you to have a lot of money, and they'll give you that if you buy the plus version. I mean, so there's different tiers of Robinhood. So if you want to get that extra like whatever percentage on cash, then yeah, go to Robinhood. And I think Interactive Brokers has other deals. Like, all of them have their pros and cons. All of them do. The only ones I really don't like is probably like any of the banks. Like, don't use a bank to do your brokerage. Don't do Wells Fargo. Don't do Bank of America. Okay, they limit you in what you can do. If you're a boomer and you already have like a big bank account there, fine, use them. Okay, use them. But but if you're not lazy, most people can easily transfer money in and out of different accounts, right? And they know how to use a computer and your phone. I see no reason why you shouldn't have a gazillion accounts. It's better just to do it. And it's great because just in case like one brokerage doesn't work, like let's say you have a GameStop event, like the market is doing some funny stuff and you can't trade in one account, at least you have another account. At least you have another account. You have all the accounts like open, then yeah. So there's a lot of usefulness where you just pick the big core ones. I think you will have a Schwab, you have a Fidelity, one or the other or both, and then you have like Interactive Brokers and Robinhood for the second. Interactive Brokers does overnight trading. So does Robinhood. Interactive Brokers has more stocks you can do overnight trading. So if you're really active in trading, and yeah, and then Robinhood, like, yeah, it's very easy for you to get options. So if you're really so keen on just jumping into options right away, then yeah, you probably should just get Robinhood while you wait for your application in Schwab or Fidelity to go through. All right, something like that. So that's about it. I think Vanguard is probably at the same level as the banks. they'll limit you. They don't like you doing risky stuff and whatever. So some people that like to do risky things, then Vanguard doesn't make much sense. Vanguard might give you more options with mutual funds or something like that. But I think for a lot of you guys that don't have big accounts, probably, and you guys are more aggressive, if you're younger, then yeah, you probably don't need the Vanguard. I don't see anything using that one. All right, interactive brokers and brokers. Let's see, brokers. Let's see where the website is. Yeah, I'll give you that. So here you can see what they're offering for overnight trading. That's one of the beautiful things of interactive brokers. So here I'll give you a link. You guys can go there. So that's one of the beautiful things. Robinhood does have overnight trading, but it has a limited selection of what stocks and ETFs you can trade overnight. So that's a real good thing when you don't have a knowledge of using futures. But then again, you might, if you are interested in trading stuff overnight, you should look into futures, because when you trade futures and you know how to do it right, you get a nice tax benefit, because any trade you make with futures, they tax 60% of it long term and 40% short term, meaning you can day trade with futures, and 60% of that trade is taxed as if you held it for a year or longer. Okay, trade most ETFs. Yeah, see, there's our pros and cons. That's why I think if you're really a big time trader, you should have all the brokers that give you certain features that you want and use them all. You know, for me, I'm a boomer. I don't trade that much. I don't do options. So like I have one Robinhood and one Fidelity as my main accounts. That's it. I don't want to mess with like anything else. But if you really needed more, you should just do more. And it's better to open accounts now than later, because every time you open a new account nowadays, they ask so many questions. When back in the 90s and when it first came out to do online trading, they barely asked you anything. Social security number, your name, your legal name, and that's it. You're done. Open an account. You don't need any money in there. You know, now it's like, well, are you real? Are you a real person? Are you a scammer? And then you have to wait for them to verify everything with the IRS or whatever. Fucking annoying as fuck. So yeah, especially after COVID, when everybody started gambling. So yeah, do it now. Even if you don't think you need to have a brokerage account, like do it early, right? And do your IRA accounts or whatever retirement accounts if you don't already have any set up anywhere. Then yeah, you should do it as early as possible. Get it done. Just get it done, you know, because you don't know how long the turnaround time is. Yeah, it's like my mom had to open one, like these accounts, or like my dad, and then they asked so many damn ass questions, and I was like, God damn, when I did this stuff and opened new accounts back in the old days. So yeah, we're living a new era. People just want to ask so many questions, just especially with the crypto too. Before you could just do whatever you wanted, right? It was a wild west. Okay, so Baidu, that was one. Yeah, I was talking about Ernie, the AI. So they had new AI and it pumped a little bit, but you can see this chart here. It's like, it's ugly. The Baidu really is terrible. I don't know if this is gonna really zoom out after all this AI news, because this could only be temporary. I don't like this chart. I don't like this. Like Baba is way better, right? JD as a chart, I think looks better. Yep, JD definitely looks better. And then you have other ones like Tencent, Baidu, all these things. They just look way better. You don't want anything else. Well, yeah, Tencent's like really good now. And of course, like my favorite, Xiaomi, like the best Chinese stock ever to have. XIACY on the over the counter. So from October 22, $5, $6, and now it's at 37. It almost hit 40. Beautiful, beautiful. Okay, and then the next one was BYD. Let's see what happens. I don't know. BYD could be another winner, a big time winner for me. But Chinese stocks are Chinese stocks, though. You have to know when to pull out. Don't be thinking you can hold it like an American stock for 10 years. All right? You just get in and you just get out. That's it. When the time is right for Chinese stocks, they work well. When the time is bad for Chinese stocks, you better short them. All right, so KC is another one of my favorites. I don't put much money in here because it's a wild, insane stock that it still acts like a penny stock. I have no clue if this thing will shoot up to like $60 from here or not. I haven't decided if I want to add to it. I'd rather just chill and wait because you can see right here. You can see right here. This is kind of near where it started trading in the U.S. markets, around $18.50. You see, we're just hanging here. So we could return to $10, which is what I'm hoping for still, because I didn't add here. I was like, well, is it going back to 7 and then go up? Well, if it's going to go up, then I'd rather wait for 10 again and then go back up. Okay, so that's something to watch. I don't know. This thing makes no sense to me. I think it had earnings, but it didn't react to it. You can see it had earnings. Didn't react to it either. So KC Kingsoft, yeah, Kingsoft Cloud. Oh yeah, whatever. Kingsoft. No idea what they do anyway. It's just some cloud company. Somebody asked me about GitLab too. GitLab just pulled back. Oh, this thing is just disgusting. What's wrong with this one? And then the other one is RDDT, Reddit, right? Reddit. Oh yeah, Reddit. Let's see if it gets back to 71. Let's see Reddit. Yeah, it goes up, it goes down. All right. Okay, that's about it, I think. I talked about some other stocks last time too. BKV. It's bouncing from that IPO price, but that's probably temporary. It might go lower in a month. Okay, Boeing, it bounced off that level at 151. All right. Yeah. I'll keep my eyes on Boeing. Yeah. BA. Intel, because these are just blue chip stocks. So if you need something long term, like Intel right here, you see, it's fighting at that 24 again. So there's a lot of these blue chip stocks I'll pay attention to. The only one I really recommended to that I'm confident in is Deere, so tractors, and it's doing a good job holding. So it's staying above that 441 area pretty nicely. So yeah, I could see it continue to do well. Okay, the other one is natural gas. Talk about natural gas. All right, it's pulling back. Okay, so it's pulling back to the area. Okay, it went back to $3.88 per million BTUs. Okay, so tomorrow we'll have a report from the Henry Hub, the weekly report. I'll see how Boyle will go. Boyle may start dropping into next week if it's a bad report, because we're done with the winter. I don't really know what's gonna keep pumping this sucker up unless Trump keeps saying something. I think we've hit our limit for now, and it will come back in May with oil and coal. But coal prices are down. Oil price is still down. So it's really hard for me to say like this thing will just continue flying up through the spring. All right. I think this is gonna go sideways at least. So I can wait. I can still wait a while. I'm not interested in the next move up. But for now, like let's see. It got like $38 from December to 100. Not bad. Not bad. I'm expecting more. Another 100, 200% from here. Let's see. 200%. So let's say if it went from $90 and it went up to like 150%. Let's say. Okay. So let's say it got 75% on natural gas. Let's see. This is a rough estimate, though. I can't be sure if that's going to be true. So 75% would take this to about... I'm pretty optimistic if it gets to 75% this summer. Back to $7 for natural gas. Yeah, it's possible. That's back to the old highs from when Ukraine got invaded, when it first got invaded. And all the pipelines started getting blown up between Germany and Russia. So yeah, that could be good. Could be a good one. All right. Hopefully. Gold, I'll still have to wait a while. Let's see anything else. And then wheat, corn, soybean. Yeah, watching these. So WEAT is the ETF for wheat, corn, CORN, and soybean, SOYB. And the first video I played, you're going to have a report on agriculture, U.S. agriculture, at the end of the month. So next week, we'll see. All right. Okay, let's play this next video. Let's see what the AI chatbots are doing for Google.
If Google's iron grip on search is about to crumble, we have come to the right place. Today, we're diving into the explosive growth of AI chatbots like Grok, Perplexity, and ChatGPT, and how they're threatening to obliterate Google's search empire. These new tools could change everything we know about the internet. If you're invested in Google, we're going to show you exactly what metrics to be monitoring going forward. There's also a big surprise at the end of this video that you're not going to want to miss. So let's start with the scuttlebutt. Articles like this one. So it talks about how Google's market share has dropped below 90%, which is quite remarkable, for the first time since 2015. And when you look at these sort of metrics, the search engine market share might not capture the full picture. That's because people might be using chatbots for certain types of queries and Google for other types of queries. So even if chatbots are gaining traction, it doesn't mean that Google's automatically losing market share. Chatbots are certainly better for more conversational, deep sort of queries, whilst Google is good for just pulling up websites or facts or specific things you're looking for. Now, if Google's losing market share, that's bound to affect their advertising revenue, so that's probably a better place to be looking. So when we look at Google's revenue growth over time, it's actually quite remarkable. There doesn't seem to be any problems here, but you need to remember that Google's actually divided into three components when it comes to how they segment their revenues. Google Services revenue is where we'd want to be specifically looking. So what we can then do is break out Google Services revenue, which reflects their ad spend, and compare that to total revenue growth. We've done that here, looking at the growth for each year, and the column on the right shows the difference. So we've done that here, looking at the growth for each year, and the column on the right shows the difference. So what we see here is that largely the growth in Google services, so ad revenues, reflects total revenues growth for the most part over the years. And what's interesting to note here is that back in 2015, this Google Services segment accounted for 99% of Google's revenues, whilst today it accounts for just 85%. Why? Well, because Google's been building a very successful cloud offering. They're trying to diversify away from just ads. You also see that with them dabbling in things like Waymo and their moonshots, many of which haven't come to fruition. But this still isn't an accurate portrayal of Google's ad revenues. For that, what we can do is dive into their last SEC filing, and what we find here is that they've broken that down further into Google Network, YouTube ads, and Google Search and others. So Google Search and others, what we want to be paying close attention to. What we've done here is we've taken that particular revenue segment, plotted it over time on a quarterly basis, and then looked at quarter-over-quarter growth. So the first thing you'll want to note here is the seasonality. So be careful about interpreting one bad quarter as a downturn in Google's ad revenues, when in fact the first quarter of every year seems to be a down quarter. So you'll want to be careful on how you interpret that. But certainly plotting this number over time would be one more accurate way to see if the ad revenues that Google receives are being impacted. And what we can then do is we can start adding in data from other firms that get their revenues largely from ads. So what we've done here is we've added in Bing search revenue estimates. And you can see what's interesting here is that the growth for both of these seems to have some sort of similarity. And in order to determine how correlated these two growth numbers are, we can actually look at the correlation coefficient. And what we've done here is asked Grok to figure that out for us. And Grok finds that the correlation coefficient between ad revenue growth for Google and ad revenue growth for Bing is at 0.94. So at a 1, they would be perfectly correlated. So they're very highly correlated. But there's still a problem here. You see here how Meta's Q4 ad revenue jumped to a remarkable $47 billion, driven by AI-powered ads. So what's going to happen here is that Google's going to start to see a lot of success using their Gemini AI to run better ads and drive up ad revenue. So you're going to see ad revenues going up. What you want to pay attention to would be impressions. In other words, the number of ads that are being served up. Couple problems there. First of all, I can't imagine they can add more ads. It's getting ridiculous now. They seem to have saturated their entire search engine with loads of ads. So adding more ads doesn't seem possible, but that's one way to tweak that metric, right? You just, if you're getting a lower number of searches, just increase the number of ads and impressions stays the same. The other problem is Google doesn't report that. So Meta seems to sporadically refer to the growth of impressions, but it also doesn't report those metrics. So if you're an investor in Google, a large investor, it would be good to pressure them into being able to see this impressions number. That's probably the most accurate way to measure whether or not Google's being impacted by people not using search so much. That's what we're talking about here. Revenues, their ad revenues, we can expect those to go up because of AI. So there's three measures we've talked about. You can look at search engine market share. Chatbots aren't search engines, so that isn't going to be that effective. Search revenues are deceptive for reasons we've talked about. And what we can then do is perhaps look at chatbot usage as a proxy for search share being captured. So what are the most popular AI chatbots being used? Well, we've been looking at AI chatbots for a long time, and this piece we did, well, it's almost a decade ago, The Myth of the Clever AI Chatbot. We pointed to the fact that chatbots at that time were largely rubbish. We said chatbots will most likely be the next thing, but so far, the existence of a clever AI chatbot seems to be a myth. Now, over the years, we continued watching chatbots. This one firm in New Zealand I went and visited. They're turning AI chatbots into digital humans. And to be honest with you, I haven't seen any sort of digital human yet that's compelling. If you're somebody that looks at these sorts of things a lot, they just aren't overly convincing still to this day. But I like this quote that somebody had said, AI is the worst it will ever be today. So AI is always improving. When we get to the point where a digital AI avatar is imperceptible from a human, we're going to be in a lot of trouble in terms of jobs being lost. Things will also be good. There's pros and cons to that. Now, when we think about how AI interacts with the world, I think the three monkeys do a good job of describing that. So AI is really good now at conversating, at listening to what you're saying, being able to navigate through typos, to infer things based on what you're saying. When it comes to speaking, as I said, it has a lot of room to improve. And of course, you have computer vision. We see that with autonomous driving. So that listening component is really what's driving AI chatbots and the ability to articulate themselves as well. So when we look at the top generative AI chatbots, started to go down this rabbit hole, and you find a table like this. Now, this would be great if it wasn't lead magnet rubbish from some SEO firm that's demonstrating to the world how successful they are in getting their results to rise to the top. Unfortunately, it doesn't add any value. Now, you need to be careful when you're using AI chatbots, because what they'll do is then pull in things like this table. And again, I'm not saying this table isn't accurate, but when you go to try to find sources, they just talk about how their team put it together. It seems to be a small group of individuals. When you actually go to get the report, they say, we'll contact you. It's just a lead magnet. So unless they're going to make that available and we can verify sources, it's largely useless. What Perplexity has then done, when you ask them the same question, they pull up this data as if it's just a fact. Well, when you ask Perplexity where it got that data, it says this first page Sage firm. So when you put Grok into think mode, it's rather remarkable. It thinks this whole thing through and it puts together a table with ranges, which is the sort of answer you'd want because you're going to get a lot of different estimates. And what I think is indisputable here is that ChatGPT seems to be dominating the AI chatbot space. Now, Grok talks about how these figures are approximate, and that's absolutely right. But then what we can do is perhaps look to mobile data for more answers. And there's this report by Sensor Tower. It's remarkable. It might be one of the best reports I've seen in a long time. And what it does is it talks about the usage of apps on mobile. And the first thing you'll notice, the yearly trends for generative AI apps, they're going through the roof, as you can see here, in terms of downloads and also in terms of IAP, that's in-app revenue. Now, what I found interesting is the United States is the global leader when it comes to generative AI app revenue at 45%, with the UK sitting in second place at around 4%. So the revenues there from other countries are quite fragmented. And when you look at the quarterly downloads by genre when it comes to AI apps, you have the AI art generators. Those were popular for a while, still are, but AI chatbots just through the roof there. And we can look at top AI downloads. Look at this. ChatGPT understandably being at the top, but in second place, Google Gemini. That's rather interesting. In third place, you have China, and then in fourth place, Microsoft, right? This is not going to include Grok because Grok lives within the X umbrella. Now, what's interesting is when you start to look at downloads for specific places. So worldwide is what we just looked at, but then you can start breaking it down by country here, and this gets rather interesting. You see some sort of Luzia chatbot that's becoming popular in South America. But when you start to look at chatbot downloads in the Asia Pacific region, see Google's really dominating in some heavy population centers like Indonesia and India. So Google's certainly making a lot of headway with their AI chatbot. And where this might stand to work really well, and is trying to do, is establish this everything app. You'll find these in Asia, right? It's an app for payments, ride hailing, questions, things like that. So you integrate AI into the other apps that you're offering, and this is what X is doing with Grok. Well, Google can also do this with Gemini. When you look at the apps that have the most monthly active users, you see the top 10 here. 4 of them are from Google. So you have Chrome, Google Gmail, Google Photos. So Google's deploying Gemini on its own, but also it's integrating Gemini into these other offerings. So the question becomes, how can we track Gemini revenue, right? Because then we can see how much of an impact that's having on Google. In other words, if Google can make Gemini a big success, it doesn't matter if they take a hit on their search revenues, the ad revenues from search. So when it comes to Gemini monetization, this last quarter, Google said that AI overviews increased search usage, with ads monetizing at rates similar to traditional search. So you see they're pointing out the fact there that they're not getting hit on the usage of AI. Google One, so this is their subscription offering, has surpassed 100 million subscribers in a premium tier. Their features Gemini Advanced. I've certainly seen that peddled. They have 4.4 million developers using Gemini as of last quarter. That's doubled in 6 months, so that's rather remarkable. So AI is really a growth driver for Google and not a distinct bucket at this point. However, one wonders how Google ever lost their AI leadership. And we did this piece. It's well worth a watch. It was several years ago and it was spot on. It talks about Google's AI problem. And we said here, AI was supposed to be your secret weapon, but you spent the last several years having it sabotaged by activists. And that's exactly what happened. So if you want to see how Google fell behind, I think this piece does a good job of portraying the story behind that. So you're all waiting for the big surprise at the end of the video. Well, here it is. That video intro, that was generated by Grok. All tabular data today came from Grok based on 10Q and 10K filings. Those slick tables you saw with the growth numbers and the various comparisons between Google and Bing, those were all done through conversations with Grok. It's extremely slick. In fact, this isn't even Joe speaking, it's Grok. Okay, maybe that last statement is a lie, but if Grok becomes capable of doing what we do here at Nanalyze, it's certainly welcome to take over. Until then, we're going to continue adding value to your investment process with videos like this one. So certainly you've been noticing the dominance of ChatGPT and wondering how you might be able to.
All right, guys. Okay. Now, I'm going to play the next video, but first, let's read some articles about the Fed, and then we'll proceed. But, yeah, it gives you a good idea how stuck these big tech companies are to make money, right? A lot of the S&P 500 is driven by Facebook, Microsoft, Google, NVIDIA, Apple, all these guys. They're all trying to get stuff ads into everything. And AI is being leveraged, but how much more growth can you get, right, in terms of money? You have to charge people something. People have to pay something. If all the people just want to use the free AI offerings, they're going to have to try to get all the people to upgrade, right? That's the whole thing. You get the bait and switch. You give them the stuff for free and then slowly say, "Oh, you want this AI feature. Now you got to pay a subscription. Now you got to pay another thing." Yeah, what's up, Solid? Okay, so let's see here. Let me get that stuff. All right. So this is the BYD, okay, the Chinese electric car. BYD shares hit record high on 5-minute electric vehicle charging claims. Well, is it a lie? Is it not a lie? Leading Chinese electric vehicle maker says latest models can charge up as fast as filling a petrol tank. Petrol, aka gasoline, for you American viewers here. This was published probably yesterday. Shares in China's electric vehicle champion BYD touched a new record on Tuesday after founder Wang Chuanfu claimed the Tesla rival can now charge its EVs as quickly as it takes to fill a car with petrol. BYD's stock jumped 4% to 401 Hong Kong dollars, or $51.66 in Hong Kong, taking its gain to 85% over the past 12 months. Beautiful. Wang, the company's billionaire founder, said on Monday the Shenzhen's group new charging system for BYD's own EV batteries could add around 470 kilometers in range in 5 minutes. The claim implies that BYD has nudged ahead of rivals such as Tesla and Mercedes-Benz in fast charging technology, although the new system is contingent on several prerequisites, including sufficient voltage at charging stations. Now, if you remember, I talked about BYD way back when, right? Looking at just the chart. Then I started saying, if you look at the history of BYD, they started as a rechargeable battery maker. First by doing the nickel cadmium, and then later nickel metal hydride, and then lithium ion later on. So they've been doing battery chemistries for quite a while, basically lifting it from Japanese tech. So they took the Japanese tech and then started working on it, because I don't think Japan cared about a lot of low-end battery technology, but they gave it to China, and China built it off of that. Okay. There is rising competition among EV and battery makers to deploy faster charging infrastructure, in part to help deal with anxiety among consumers over the driving range and charging speed of EVs compared with traditional internal combustion engine cars. BYD initially plans to install around 4,000 chargers to support the new fast charging technology. China is expected to put in about 460,000 new public EV chargers this year, accounting for about 2/3 globally, and taking cumulative units to about 2.1 million, according to Chris Liu, a Shanghai-based senior analyst at the consultancy Omdia. BYD added that 2 of its popular sports utility models, both priced under $40,000 in China, would be equipped with a new ultra-fast charging system from April. The latest price bump for BYD, which counts Warren Buffett's Berkshire Hathaway as a significant investor. Well, now you know who bought it, didn't you? So if you looked at the chart, it was in a range from 2021 up till now, 4 years. The stock price has been in the range, and now it's going up. Well, guess who bought the last big chunk at the bottom of that range? Probably Warren Buffett. Comes a month after the company rocked the global automotive industry with the release of a free advanced self-driving system dubbed God's Eye. Oh, great. All right, God's Eye, that it plans to install on its entire lineup of new cars. The moves heap more pressure on a clutch of domestic rivals, as well as Elon Musk's Tesla and Germany's Volkswagen, which have lost market share as Chinese EV sales boomed in recent years. For the first 2 months of 2025, BYD boasted about 27% of Chinese EV production, with sales of more than 405,000 cars, according to data from Automobility, a Shanghai consultancy. It has an 18% share of the pure battery EV segment and 56% of the plug-in hybrid segment. BYD, which is rapidly expanding globally, through new factories in Southeast and Central Asia, Europe, and South America also accounted for about 16% of more than 900,000 cars exported from China in January and February. Yeah, it's undercutting a lot of the German cars as well. So Germany's not getting a good bargain on their trade deal, have they? Huh? Okay, so anyway, going back to the Fed, I just want to read this one here. Fed leaves rate unchanged, notes higher uncertainty. So I'm going to skip everything here, and I'm just going to tell you this one. This part is the most important. This is the reason why the market went up on Jerome Powell. The committee also announced that starting next month, it will withdraw its pandemic-era support for the financial system more slowly than it has been. Under the change to its quantitative tightening, the Fed will allow the portfolio of Treasury securities on its balance sheet to fall by only $5 billion a month, not the current $25 billion. So they're reducing the sale of bonds by 5x. That's a big deal. Big deal. So they are afraid. I think they probably read that Goldman Sachs note yesterday, because Goldman Sachs was saying like the Fed was about to make the same mistake it did in 2018. And if you remember 2018 was the reason why I started looking more into trading than investing, because that was when volatility started increasing. The Fed was stuck. They couldn't stop what they were doing from 2008. We're still in the 2008 mode. We still are. The Fed still has bonds to unwind. We've been living on low interest rates for a long time, and it's still in the system. It's still inside the system, you know? So there's a lot of blood flowing around that still hasn't been leached out. We haven't got the leeches everywhere on the body to leach out all that extra blood that's moving around the system. That's why you have people complaining like Martin Shkreli. Why are the stocks still so expensive? And you have a whole bunch of people thinking there's a crash every month or something. There's going to be a crash next month, this month, that month. No. It'll crash when they want it to crash, all right? That translates into a slight easing of the Fed's monetary policy stance and is good news for longer-term borrowing costs and the value of financial assets. Right there. And the value of financial assets. Governor Christopher Waller dissented from the change to balance sheet policy. So one guy didn't like this, while agreeing with leaving interest rates unchanged. It is only the second time a governor has dissented from a monetary policy action in the last 2 decades. So usually these people are just yes men. Whatever Jerome Powell wants, they'll all say yes, 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 and clap. But this is the second time so far that somebody said, nah, I don't like this. Uh-oh. Something's going to break pretty soon, man. All right. I'll read the full article here from Bloomberg. Fed to shrink balance sheet at a slower pace until debt ceiling deal reached. Oh, okay. Well, this was written today here. The Federal Reserve said it will shrink its balance sheet at a slower pace beginning April 1st until the federal government can strike a deal on the debt ceiling. So is that the reason why? So they will keep on doing this until they're comfortable with what Congress does with the debt ceiling. Interesting. All right. Officials who left interest rates unchanged on Wednesday said they'll lower the cap on how much in treasuries is allowed to mature without being reinvested to $5 billion from $25 billion. That's what I read. It will leave the cap on mortgage-backed securities unchanged at $35 billion. Oh, well, they still want to dump their little mortgage-backed securities, huh? Fannie Mae, Freddie Mac, anybody? The central bank has been winding down its holdings since June of 2022, a process known as quantitative tightening, or QT, by gradually increasing the combined amount of treasuries and mortgage bonds it allowed to run off without being reinvested. It last lowered its monthly cap in June of 2024 to $25 billion from $60 billion. The latest move comes as lawmakers look to strike a deal on the debt ceiling, the statutory limit for outstanding Treasury debt. The U.S. hit that limit in January. The longer it takes Congress to either suspend or lift the limit, the more cash that will make its way back into the financial system. That has the potential to artificially boost reserves currently at $3.46 trillion, masking money market signals that could indicate when is the right time to stop QT. It's those money market signals that will dictate just how much more the Fed will be able to shrink its $6.8 trillion portfolio of assets before worrisome cracks start to appear, as they did in 2019, ahead of an acute funding squeeze. Most of you guys don't remember 2018 to 2019, and that was before COVID. So that's why my little conspiracy hat always thought COVID was just because they needed something to get out of their predicament in late 2019. Either they let the bubble up and explode, or they pop the bubble themselves on purpose. Okay, that's the conspiracy side of me thinking here. So don't take that as fact or anything. For months, officials had said very little publicly about when they might stop reducing their balance sheet. Minutes of their January meeting, however, revealed policymakers had discussed the potential need to pause or slow the process until lawmakers can strike a deal over the government's debt ceiling. The New York Fed's Roberto Perli, who oversees the central bank's security portfolio, reiterated these concerns during remarks earlier this month. All right, that's it for now, guys. You can read these yourselves if you want. They are in the description. What's up, Brushu? All right, so now I'll play the next video here. This is Jeff Hirsch from the Stock Market Almanac. So he'll give you a little summary on the seasonalities that he sees for the presidential cycle so far. We're almost done with the first quarter, okay, of this year.
Hello, everybody. I am thrilled to welcome you to my inaugural podcast broadcast. Thanks for tuning in. So I'm going to run through some things, about the market, my outlook, how we look at things. And since it's, March 14th, pretty important point in the market currently, 2025, I'll update, my forecast outlook and where we've been, and then give a little preview of what's coming up. We got the, luck of the Irish helping us out here on Friday. The Ides of March, things are bouncing. And then I'm going to finish up with, it'll be my honor to interview Larry Williams, one of my old friends and mentors, who's, just honored us with his presence on the first broadcast. So it's perfect. So, I put out a forecast in 2020, the end of the year, right around December 19th, was a little bullish, base case scenario, about 65% probability. We thought that the bull market could, tack on average gains about 8 to 12% with pullbacks in Q1, Q3. We are getting that pullback in Q1, very typical post-election year, choppy trading, as Wall Street navigates Washington and the Fed and try to balance, the inflationary forces. And then, the best case scenario was the Trump administration just hits it out of the park with very few missteps. Inflation, is contained, doesn't overheat, geopolitics cools, and we get a little bit of higher returns of about 12 to 20%. Then the worst case scenario, which has the odds have increased with what we've seen in the charts of the markets. Post-election years have been a lot better in recent years. And I'll show you a couple of charts, in a second. But before 85, post-election years were rough, especially for Republican administrations. And they come in and try to take care of things very quickly. We've seen that happen right now this year in 2025 with President Trump 2.0. like never before, at least as far as I can remember. Maybe Larry will remember something from before my time, but pretty much old school weak Republican post-election performance is on the table now. Refers to page 28 in the Stock Traders Almanac 2025. So basically, perhaps a little too much drastic, too many drastic measures. People are worried, uncertainty, et cetera, so forth. So let me see if I can just pull up a nice little chart for you guys here. This is the post-election year seasonal patterns right out of the outlook in the 2025 almanac that I wrote last June. We've got all election year, all post-election years in black, 5th years of the presidency in pink. That would be a second-term president. The blue line is the aggregate cycle. I think that's going to be similar to Larry's natural cycle. We'll talk about that during the interview, where it combines the 4-year cycle year as well as the 5th year of the decade and all years since 1949, which was the first full 4-year cycle since World War II. And then 2025 in this brownish colored line. Maybe the laser pointer will help us out here. You see, incumbent party losses the years after the party power changed hands in red, and the green is incumbent party wins. So here we've blown through that level, bringing our worst case scenario into play a little bit. Took a couple of looks from page 28 that I referenced here. This post-election. You can see some of these difficult years: 57, 69, 73, Eisenhower, Cold War recession, Nixon, Vietnam recession, 73, Vietnam, oil embargo recession. And then the real, stronger post-election years in since 85. But just, not that it's all about Republicans, taking it on the chin there. Democrats have a difficult time in the midterm years. So we took those years from Republican administrations, and I plotted them out here. We've got the blue line is the scary one with the all those administrations before 85, 53 to 81, and then all Republican administrations since 1950. If we can recover and get back up in here, we can have, a less weak year. I know everyone's cheering today with the big bounce, but let's not go crazy. We need to see some more confirmation here. And then I took this 2-year look, which is kind of interesting. I took those 3 worst year combinations where 68 was very similar to 24 with a sitting Democrat bowing out, convention in Chicago, and some geopolitical and economic issues. So we've got the 2-year pattern here. Red is 56, 57. Green is the 68, 69. And of course, the beginning of the last secular, one of the last secular bear markets there, the previous secular bear market from 73 to 74. And then a pink line is where we are right now. That's it should be as of today's close, a little bit of up there. So this pattern has me concerned, considering what happened in 73. I'm not convinced that all hope is lost, but we'll need to see some proof. So then, let's just dial in here to the present. March Madness here happens. I was commenting to somebody out on the trail that the weather was very volatile, and jokingly like the market as well. So this end of first quarter, we see this March volatility, and I posted this the other day out on the blog and Twitter sphere and all the social media that we could be setting up for this Ides of March bounce. In the recent 21 years on the solid line, we've seen the beginning of March quite weak and then bounce at the end of March. That doesn't preclude us from having some further weakness towards the end of the month. Triple witching, if you want, or quadruple witching, as people refer to it now, with all the options expiring and futures expiring there the third week. Taking some end of mean quarter hits. And this brings me to the technical, aspect of things. I mean, we look at seasonality, of course, as the producers of the Stock Traders Almanac. Fundamentals, we've got some issues with GDP, inflation's waffling back and forth. I think perhaps the Trump administration is sort of sandbagging the Fed a little bit and trying to flush out some more cuts, sooner and more, and deeper. And then, sentiment. One of my favorite sentiment indicators, not shown here. Maybe we can throw that in there, is the investors' intelligence, which tracks people like myself who actually get paid for their advice instead of some survey of people who just say what they're thinking. And that went negative with more bears than bulls for the first time since I think it was September 22. And yes, that's contrary indicator is encouraging, but it's usually not the end of the downdraft when you have that first negative shift to bearishness. So and just a little look here at some of the weaker post-election year performance in March. So technically, I hope I don't have too many lines on here, but this is yesterday's close. This latest trend line that I drew here from the intraday lows of last April, the one negative month of 2024, to that August low, draws us out to what, just under 5,500. We haven't quite tested that there. And then this 5390 level I had put out here, this is from the webinar I hold with subscribers, that these lines have been there for a while. This is right at that September low, runs through a couple of gaps. It just seemed like an area. I think Katie Stockton threw that number out too, and she's a pretty solid technician and a good friend as well. But what we were concerned about, and you've seen this 5775 number out there and on the screens in public. This is the election gap, the close of election day, the gap up the next day, breaking through that, and the 50-day and the 200-day is this blue line here, and then this other 5670 line was the old July peak, the old midsummer Christmas in July peak that we had there. We broke that, and I think that gives us, there's sort of a no man's land here, open gap. Yeah, we bounced today. Let's see if we can follow through on that. But with that, I think I'm going to take a pause here, and then we'll get into looking at what's going on next week real briefly with St. Patrick's Day and Triple Witching, and then we'll jump in and chat with Larry. So stick around. We'll be right back.
All right, you can watch the rest of that video on your own, but I think that's the key, is like if you look at that March chart, okay? Let me see. Let me pull that up here.
Lows. And that went negative.
If you look at this, all right, you go down, you go up. So the Ides of March, going down into it, and then you're rising up. So on average, this is how a March performance is. Okay, so I think we've done okay for the first few days after the Ides of March, but still got a few. All right. Oh yeah. All right. Panelverse says he sent John something. Yeah, John's not here on this panel, but yeah, please email him. Okay. But I'll let him know. All right. Okay, screenshot that. All right, so okay, now let's go on to this video here that I found. All right, and I think this will talk about that caller from JP Morgan. So let's see if I'm right, if I remember correctly. And then we'll be done for tonight. And yeah, Samantha had a little presentation today. I saw a little bit of it. It goes more in depth into options. So I have a collection of option videos I want to present to you guys if whoever wants to deep dive into options. So I got to line them up and make it so that I go through it for you into maybe 1 or 2 streams, maybe something like that.
side continues in these markets and the rotation to more risk-off defensive sectors continues to be the play. In today's Stock Market Brief Show, we're going to hop into some of the big picture charts. We're going to be diving into some of the divergences that we talked about when we were leading up to the all-time high in the market, because I think it's going to be important to revisit these if we start to see positive divergences form. We're going to go into market conditions and the expected moves. Really, we got to also talk about how we really haven't seen capitulation yet in the market. So all that and more on today's Stock Market Brief Show. For those that don't know, I'm partnered here with Interactive Brokers. So if you click the link in the description there or the pinned comment, make sure you check out their campus. They offer a whole host of free tools and resources, including courses from beginning to advanced. And also a big thanks to my Patreon group, which I don't talk about all too frequently or break down everything because there's so much that I offer for $9. You could also subscribe for the year and pay $90 and it's basically nothing for all the stuff you get. This little dot alone is a huge thing right here, which is a comprehensive set of trading tick bots and the query channel. For example, if you log into the Discord, right, that's where the query channel is. You can type in various commands and you get charts for that stuff, and you have all types of commands where you can look at algo flow divergences, you can look at various gamma exposure levels. There's a whole bunch of stuff. You can look at unusual flow, whale targets, implied volatility, insider transactions, dark pool data, all types of stuff. But that's not even all of it. I give my weekly watch list, including my tight list, which are stocks from the watch list that are contracting. I post some trade ideas there. I give my zone documents, right? I give a lot of different stuff here. And then on top of all of that, I give my expected moves for things that have the daily option contracts. And now I've even included the Mag 7 daily expected moves. I do weekly, monthly, and quarterly there too as well. So if you haven't checked it out, make sure to check that out. Let's get into today's show. All right, people, welcome back to the show. So out of the 11 sectors that make up the S&P 500, we had one in the green, and that was utilities. Kind of bond related, right? There's a close correlation there. So utilities, more of a risk off sector. We had consumer staples up there too, down about 0.5%. And then towards the bottom, it was more of the risk on type sectors getting hit. And then across the board, some pretty big sell side activity. If you look at it from a year to date basis, what's been performing the best? We got miners, we got silver, we got gold, right? And when gold performs really good, it is kind of a curious sign to the markets. Gold is also not only known as a safety asset, it's known as a currency. So it's interesting to see gold, right? What's the market trying to tell us here? And then towards the bottom of the list, you got Bitcoin, which is supposed to be, right, a potential divergence from some of these risk on assets. Like people might use it for safety, but that just has not been the case. At least that was the narrative a while ago. So we got Bitcoin down about 20% here on Bito, BTC futures about 14%. Consumer discretionary is one of the laggards. IWM, which we're going to talk about in a little bit here, is down 10%. Semiconductors too. Qs are down 8.9% for the year. And some from these highs are actually in correction territory. So you can see the SPY is down about 6% for the year, but it's actually down 10% or more from its high. You can see a chart of gold here breaking out to new all-time highs. What is gold signaling to us? If you look at the rotation of the safety trade here, they've been picking up. There's gold relative to the S&P 500. Utilities has been picking up. Consumer staples, TLT has been picking up there too as well. Healthcare and defensive names as well, which is ticker symbol POWA. You can look at it in this way too, which is a relative rotation graph. You have things like healthcare rotating into the proving quadrant. You got consumer staples there. You got utilities there, right? When energy is improving or leading, that's typically not good for the S&P 500 either. And then what do you see in the weakening quadrant and the lagging quadrant? You got both our risk on assets right there. You got consumer discretionary, right? Things that people want versus the things that people need over here, right? And then you have tech as well as a lagging sector. And what I found very interesting today is I was over there on FinViz and I was like, what I'm interested to see how many stocks with a over 10 billion market are reaching 20% would be considered quote unquote bear market territory. And so I ran that 20% or more on large cap plus, and it came up with 393 names. I've stacked ranked them from highest market cap to least. I'm only showing you the top 20 right now, but on Twitter, I posted the top 100. But you got Nvidia, Amazon, Google, Meta, Tesla, UNH, Oracle, Home Depot took a massive fall today. So very interesting stuff to see and maybe names to keep an eye on because these could be bellwether type names. They're large market cap names. A lot of people have their eyes on them. They're invested in many different funds. Okay. And they're already now 20% or more or more below their 52-week high. In fact, if you go over here, this is 30% or more below their high, and you got Tesla leading the way, ASML, NVO, Palantir, Qualcomm, ServiceNow, right? We got Adobe, which recently reported earnings, got cracked today, AMD, and so much more down this list. So if you want to go to FinViz and take a look, this is a good way to see what's been getting hit the hardest, and potentially maybe once it sets back up, could offer up some opportunities for people that want to buy the dip, so to speak. If we take a look at the SPX on the weekly chart, we've had this divergence start to play out, right? And a lot of people are comparing this to over here going into 2022, where we had this negative divergence on the RSI and the MACD. And what you'll see here is we actually broke the 200-day moving average, roughly the 40-week moving average, and we ripped back up for a bounce, and then we started to kind of slosh back around. And what we're seeing right here, we have one more trading day left in the week, and if we get a big bounce, right, and close up, I mean, it really would look just like this week, right? We saw a couple weeks down, This was a pretty bearish looking red week, and then we closed up near the high. So that'd be a pretty big bounce back if we're going to get it. And then maybe we get some continuation, and then we'll go from there if that's the case. And if you look at the micro charts here, like the 15-minute time frame, we crossed below the 5-day moving average over here, and it started to decline, which gave us our initial warning sign, letting us know that one of the market conditions has been changing. We go over two different market conditions, which we'll talk about. Once again, we talk about it every video. But as you can see, we've just been seeing a series of lower highs and lower lows. And right now, what do we see after today's price action? We see another lower low. But you can see the price momentum oscillator still putting in higher low readings, telling us that the move here is going down, but the internals, right, based off of this calculation for the price momentum oscillator, has been actually upticking. You can even see that here with the RSI. We have a low and a higher low reading, and we have a differential here on the price action, giving us a bullish divergence. So perhaps maybe we do come back up and try to retest this 5-day moving average.
And that's what we exactly did these past few days. So this video was from Thursday into Friday, okay? So now we got to wait and see how much further we can go up.
Even if we were to pop right back up into here, we're going to start to average 5 days of this data, and eventually the 5-day moving average will start to flatten out and potentially give us an idea of when we can see a potential change in trend like it did right over there. That's for SPY. For the Qs, same situation. You got bullish divergences here and price action kind of going sideways. IWM, same thing. It's been putting in lower lows. The indicator here itself has been putting in a higher low, as well as the RSI there too as well, right? And we haven't really seen capitulation in these markets, at least from an intraday perspective. Typically, you can see, like if I'm looking at the advanced decline line for the S&P 100, you can see like 90 stocks all go red, but it just really hasn't been that. It's been like a 60-40 situation most days. And so I've been looking at the percent of stocks above their 20-day moving average and been really kind of waiting to see this thing really hit to the downside. And now we're finally seeing some of these names actually move into more of an oversold, quote, right? Because oversold can remain oversold territory, right? So the NASDAQ 100, right? We have only 9% of the stocks in the NASDAQ 100, or another way of putting this is only 9 stocks in the NASDAQ 100, right? Or above their 20-day moving average. You got the Dow Jones kind of creeping lower there too. It's not quite an oversold condition. The S&P 1500, okay, mid caps are moving into that oversold condition where only it's 11.25% of the stocks. And in small caps too, it's not nearly as low as it once was right here in later 2024 going into 2025, but it is starting to creep down there as small caps have been taking it on the chin lately. S&P 500 is not quite there yet either, but we're starting to see that. If you take a look at something like the Nyse-McClellan oscillator, I love looking for divergences in the Nyse-McClellan oscillator because it gives us insight to when we could potentially see turns in the market. So if you go back a few videos where we showed this bearish divergence, right? The market kept pressing higher and we're like, oh, this is giving us some sort of a divergence here. Be careful, right? If we start to get under the 5-day moving average, if we start to slip into negative gamma, because it could produce something bigger. And well, it did, right? It turned into a bull trap as we broke out higher and then we slipped off. Now, what I'm noticing here is this is a pretty significant sell-off, but we didn't even get like a minus 250 reading, which is what I would consider more of an oversold condition. This has been just like a little boop, 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 blop, 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 bloop, 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 little drop off, right? Even over here, right? We had a pretty extensive reading at minus 300, okay? And then we made a new low with putting in a higher low here on the reading, and that gave us insight. Go back to the day when we called it out, right? gave us insight that we could see the market rip up higher. So we just haven't really seen that blowout type of capitulatory move yet in various different charts. Look at the NASDAQ McClellan oscillator down here. Same thing. We've been selling off, right? It gave us some insight. Going below zero is not really a bullish sign. And then on top of that, right, this has been kind of dropping while the market was going flat. So we did have a negative divergence there. But you can see that we never really got a minus 60 reading over here like we did right over here or at the bottom of August, even the bottom of April of 2024, and even January of 2024, which marks some pretty good capitulatory type bottoms. It just hasn't happened yet. If we take a look at the percent of stocks above the 200-day moving average, right, this has been dropping off, and this is for the NASDAQ 100. This has been dropping off to a level that we really haven't seen since, I guess, November-ish, right? November-ish of 2022, which was near the bottom of the market, but the S&P, sorry, the NASDAQ 100% of stocks above the 50-day moving average still isn't even as low as it was there going into 2025. I want to look at some big picture charts now and kind of just once again reiterate the larger picture of things that have happened and where we stand, because I think it's important to know while you're trying to approach it from a tactical perspective, because when market conditions change and the bigger picture looks bearish, you might want to just pull your throttle back a bit when conditions actually change to more bearish. When they're bullish, cool, give it a shot. But when they're bearish, pay closer attention. So yesterday we talked about, once again, the S&P 500 chart. I'm not going to continue to talk about this one all too much, but right, every time we get to these new highs, everyone says this time is different. This time is different. Well, I mean, the inversion, right, the uninversion of this yield curve gave us insight that something similar could happen. And then you pair it with the Fed rate down here when everyone's like, oh, the Fed's going to cut rates. It's going to be bullish. Well, if you just go back through history, it hasn't been, right? It hasn't been. So is this time going to be different? Maybe. But maybe not, right? When we look at history, right, history suggests that it's not typically always different. So, right, can we bounce? Yeah, we can bounce. Did we bounce in 2022 and go up and then down? And yes, okay. This is the KBW Bank Index, and this is a benchmark stock index for pretty much the banking sector, and it represents the largest or the large U.S. national money center banks, regional banks, and thrifts. And I found this chart to be interesting. I've shared this one many times dating back. This is a monthly chart here. So every candle represents 1 month of data. And I have the 10-year, 3-month curve down here. I have the Fed rate just like I did on the prior chart. But I've been calling this the red zone because for some reason, every time we come into this red zone, there's been some problems in the market. So for example, over here, right, when we kind of started, this was the high over here at the financial crisis. You can see where the Fed rate was and we started cutting, right? And then we uninverted over here. Then over here was 2018 when we went into trade war, right? We had all types of global pressure. Over here was the pandemic. Then we have highest inflation, right? We had creeping inflation. And we also had the Russian-Ukraine war. And now, right, we're coming back into this area and we're down 13% on the month, right? That's not a small number. Like JP Morgan is down 20% from its high, and the KBW Bank Index is down almost bear market territory in a single month. So these aren't small moves by any means. I wouldn't know what to name this right now. Maybe this is just trying to signal that there might be more problems up ahead, or maybe this is all caused because of what's going on with the administration, the constant news feed, the uncertainty that's been growing around tariffs and so forth. Now, another thing that I like to look at is this one. So this is another chart that I haven't brought out for a very long time, the Dow Jones Global Index. And this is also a monthly chart dating back to really 2011 over here, so coming outside of the financial crisis. And what you'll notice is this is a pretty clean channel overall, and you can see we've had a few pops through it, but every time that we come down to the lower level of this channel, the Federal Reserve has done something to save it, right? So for example, we had global glow scares, right? Over here, this was Operation Twist. This is when the Christmas Eve massacre took place, right? Going into 2019. This was the pandemic, which we know led to just a bazooka of quantitative easing that shot us to the upside actually of this channel. And then we went into the higher inflation, and the war brought us right back down to the end of the channel. And now we're starting to get back up to the upper ends, and we're getting rejected from it. And we do have a bearish divergence on the price per percent oscillator or percent price oscillator, same with the RSI. So if any reason we're going to continue to just find a way to drizzle down here, pay very close attention to the lower end of this channel, because chances are if we get down there, which would be a huge move for a Dow Jones Global Index, we could very well have the Federal Reserve or some other form of stimulus or backstop come in. I find this chart to be interesting too. This is the Russell 2000 ETF IWM, right? We got the Fed rate down here. This is Russell volatility. And then we have the 10-year 3-month. And this just goes to another bigger picture chart going back to the financial crisis. We've been in this channel. It's been kind of trending up. IWM is basically going into bear market territory as of right now. Right? Maybe we get out of it tomorrow, right? Well, who knows? It's floating around about almost minus 20% from its high. And what you'll notice here is when the market is going up, when does it actually go up? When were the biggest two rallies, right? When was this big rally and when was this big rally? Well, look at what the Fed rate did. The Fed rate was basically slammed to nothing, right? So what's that telling you, right? Small caps are a good barometer on the economy. And when money's cheap, I guess the economy does quite well, right? I guess people like spending money and really driving up these smaller cap stocks. I mean, that's one way of looking at it. And then when we see the sell-off and or when we start to see it flatten out and potentially turn down, what do you notice happening in the federal funds rate? Well, it's actually when they start to raise rates and start to flatten out. When they start to raise rates and flatten out, what happened? Price went sideways. Price went sideways. What happened when they started raising rates? Flattening out. Price is going sideways. And now we're starting to cut a little bit as the yield curve uninverts, right? So slope this up, boom. Slope this one up, boom, right? Slope this one up, boom. And what do you notice here? What causes them to cut rates or drop rates at a faster rate? Well, we typically see some sort of vol event where volatility shoots up incredibly high. So this is the RVX. We shot up to around 80. Right? And then the Fed stepped in over here. Look at this big move in volatility. Russell volatility came up to about 60 or 70. So perhaps maybe if we start to see a big vol event trying to take place here in the future, right? It doesn't mean it has to happen tomorrow or even this year, but maybe if that's the case, could be something to watch. Now, as the market has been kind of coming off, I've been watching this pretty closely. I'm looking at the CPC, which gave us first and foremost, it gave us indication that things were too frothy, which is why we talked about the bull trap. Okay. And I'll tell you what the flip side of that is. And then I'm looking at skew paired to it because skew gives us a good idea of like, hey, well, what are they hedging for? What are they doing right now? And you can see skew has just been on this monster move. It's basically all-time highs not too long ago as the market kept pressing higher and higher. So there was protection being put in place. And finally, this is actually better to see skew coming off hard and fast. So this is not at an extravagant low reading by any means, but sometimes what you'll notice here is if we start slipping into 115 territory, take a look where we were there, take a look right over here. You can see that that actually kind of marked the bottom there in 2022, and it also marked the 2022 to 2023, and then it also kind of marked the pandemic low. But if you look back up now to the total put to call ratio, what do you also notice? When this thing blows out to the upside and gets around 1.2, that also pairs pretty well. So for whatever reason, if we get some crazy capitulatory event, which drives skew down and we drive the put to call ratio up even further, that could give us indication that, hey, we could have somebody step in here to protect us and or that's a capitulatory bottom in the overall markets. So another thing to watch for is just the put to call ratio to kind of creep up to and around 1.0 if it can actually get there. And when I say put to call ratio, I'm looking at it from a 10-day moving average perspective, not just the put to call ratio in and of itself. Let's take a look at some of these divergences that we talked about and where they stand right now. So the housing market, HGX, the housing index, right? If you go back down to 2005 when it peaked, it started going down and the S&P 500 continued to go up, gave us inclinations that, hey, there could be something bigger taking place. You never want to see the markets like the S&P 500 and the housing market diverge for long periods of time because they typically will need to resolve at some point. So if we take a look at this from even a shorter perspective, just a few years, take a look how the housing market going into 2022 didn't make a new high, but yet the S&P 500 kept pushing higher. On the flip side of that, look at the bottom of the 2022 bear market. Housing market put in a new high, or a higher low, I should say, and then we put in a lower low in the SPX. So the housing market actually told us that, hey, things may potentially be getting better here. And more recently, the one that we were talking about was how housing index kept on kind of dropping off here while the S&P 500 kept trucking up. We'll take a look. It's so easy to understand this in hindsight, but when it's actually taking place, when we point it out, it's typically ignored, or it's like, oh, this doesn't matter this time, or X, Y, Z. So what do we look for? Well, if the housing market all of a sudden starts putting in a higher low, right? And then the S&P 500 puts in a lower low, like kind of like how it did over here. Hey, maybe we can come back to this and say it again. Okay, look at value line geometric index, so like an equal weight. Same thing, right? This puts in lower highs, sorry, while the S&P 500 puts in higher highs, and it's been good indication that the market may come off. You can see from this high, it actually kept on putting lower highs. This kept on putting in higher highs, giving us an insight that's saying, hey, this very well might play to the downside. So once again, on the flip side to this, if we start to see a higher low, right, or matching lows while this puts in a lower low, we can come and revisit this. Here's another chart that I shared quite some time ago. This is the percent of stocks above the 200-day moving average in the NASDAQ composite. And we talk about how it's important to continue to watch this as a breadth indication, but to also be aware that these type of things can last for years or a year, right? So you can see when we have smaller amount of stocks that are performing stronger, but yet the market itself is going higher, it's been giving us warning signs that we could be coming into a turbulent period. For example, when we had our bazooka of quantitative easing, we shot up so significantly high. All stocks were performing good. But then this thing all of a sudden started to change. More and more stocks broke down. More and more stocks broke down. But the market kept on continuing to press higher. That gave us warning signs saying, hey, this is getting pretty darn frothy here. Now, that lasted for an entire year. And then we went into our bear market. Take a look over here. We put in a higher low reading, meaning that more stocks now are above their 200-day moving average, but yet the market's crumbling. That gave us indication that we could be finding a bottom. Okay, where are we right now? Well, we started seeing lower readings. The market kept on pressing higher. Now we're resolving ourselves. So where can be an oversold condition if it wants to continue to capitulate? Well, down here at around 15 to 20%, we've noticed that when it comes down into these levels, it has marked some significant bottoms or near the bottoms of the market. Take a look at these divergences that have been building. This is one that I haven't shared for quite some time. If you're familiar with Dow theory, this is another kind of way of looking at it, right? People look at the industrials and the transports and so forth. Up here is the Dow Jones Composite Average. And for those that don't know, the DJA, right? The Dow Jones Composite Average, it's not the industrials, right? The Dow Jones Composite Index is comprised of the industrials, the transports, and the utilities. And what I found interesting here is the industrials were matching up new highs, right? Matching new highs over here. But the thing was, transports and utilities were completely diverging over here. And sometimes when this is the case, if these don't resolve and start to match what's going on over here, one, the Dow Jones Composite can easily start to slip off if these divergences build. But it's also indication that Dow Jones Industrial Average may come off there too in the near future. Now, another way to look at this, a more newer age, is to look at compared to the Russell 2000. So take a look here. This one is the Russell 2000. Up here is the Dow Jones Industrial Average. And take a look how we were making new highs. That's what these red lines are. New highs in the Dow Jones Industrial Average. But what was small caps doing at the time? They were telling a different story. We put in matching highs or lower highs. Lower highs. Remember this over here in 2021 going into 2022? Everyone was talking about this big breakout. Well, we had a massive breakout. But what happened over here? We came back in being a bull trap. But yet the Dow Jones Industrial continued to press higher, and then we led into a bear market. Even over here more recently, we had matching highs, and small caps was just not confirming this move. And once again, it looks a lot more obvious in hindsight. Take a look over here, though. See, Russell 2000 actually happened to put in a higher low while the Dow Jones Industrial Average kept on continuing to press lower. And that gave us insight to what? The bottom of the Dow Jones Industrial Average move over here. If we take a look even dating back further to 2007 to 2008, right? Because people probably want to know about this. Industrial Average put in a new high. Small caps did not confirm. Led into the financial crisis. I know it's not this easy to understand this or to just make a call off of this, but it's something to have in your pocket, right? And it's a piece of data that has historical, evidence or historical proof that it has worked and that it has mattered in the past. Let's take a look at our current market conditions. First and foremost, we like to look at the backwardation, right now, currently of the VIX futures curve. This has kind of been a hot topic here, and it's telling us really in layman's terms that, hey, we got problems right here and now, and we see problems kind of resolving into the future. Typically, you don't want problems here right now. You want to know that we can have problems into the future. And as this is going on, right, back month versus front month is still rather extended in an area that does suggest that we can start to try to find our bottom around here. It's been about 4 or 5 trading days, maybe a little bit less, that we've been under this 1.0 marker, which I don't have the chart with me right now. And we can very well elevate from these levels still, which we've discussed earlier on this video. If we take a look at one of the main market condition elements that I use, which is the gamma flip line, we've been under this now for like 15 trading days, I believe it is. So 15 trading days we've been under the gamma flip line, and this
is an important part right here. The 5,800 is where the flip line is.
This is where selling begets selling, buying begets buying, and volatility typically increases. You can see that here every time we've been in negative gamma territory. I've highlighted it in gray boxes, and you can see this entire run right here has been in negative gamma. So the day that we crossed through it, we were probably on a live stream where I talked about it, to the minute when we cross under it, to be more cautious and aware given the context of the bigger picture. And well, we've continued to kind of just press lower here, looking for opportunities, looking for bounces, but being well aware that market conditions are still not that great. The second thing that I use is...
Okay, so I'm going to go back here to look at that chart again.
Has been in negative gamma. So the day that we crossed through it, we were probably on a live stream where I talked about it, to the minute when we cross under it, to be more cautious and aware given the context of the bigger picture. And well, we've...
Okay, now look at the bottom orange line. It says JPM collar long puts 5,565. And then you have the upper orange 6,165 JPM collar short calls. So this is a collared strategy. So there's a big ETF from JP Morgan. All right, so JPM, I talked about it at least a couple times on here. JPM collar, you can look it up. JPM collar. Okay. Yeah, here, I'll give you the link. You can look at it yourself. All right. Right there, spotgamma.com. They'll talk about the JPM collar for you. You can go to that link. Now, if you look here, so this is set every quarter. Every quarter it's set. It will end at the end of this month. Now, so that means the stock market, the S&P 500, tends to stay between these two orange lines, right? We've been touching the bottom of the bottom orange line. That's where the JPM collar long puts are. And then we get a hard time trying to get over the JPM short calls at the top. So we hit the bottom, and we're going to go all the way back up, at least, hopefully, towards that gamma flip line at 5,800. All right, which is also something that Samantha LeDuc also has said. All right, so we're done with that today. I think that's good enough. It's 1 hour, 30 minutes. Let me refresh your memory here with the S&P 500. Okay, and let's see what's going on there. Let's see, Bitcoin still stuck at that 86,000 area, so not important there. But so let's look at the S&P 500. All right. So this was one possibility if we had held at 575. So this rectangle here of 570 to 575 on the SPY, we could have bounced back up into this higher triangle here. Rectangle at 592 to 597, and we have this sign line at 585 near that gamma flip line, which was the old high of October 16th of 2024. So now we're trying to climb into this lower rectangle range at 569 to 575, right? This is the area where we are. If we can get through it, then there is a chance next week it can get to 585. Now, if it doesn't hit 585, maybe it just fails completely here and just starts rolling over. Yeah, bad sign. But, if you're lucky, it can try really hard to get and once it crosses that 585, it will tag again at 595. That's where we'll be. Okay, and if we look at the NASDAQ, QQQ, we're in a worse state here because we actually had to touch a lower low at 468. And 467 or 472, 468, 472. And this was the gap set in June of 2024 right here. And it was actually a place where there was a lot of fighting going on in July as well, 2024. And then another one at August 2024. So, yeah, we will have to struggle through 500. So NASDAQ still Has a lot of ways to go at the 498 to 500 area, and I think it'll get stuck there. It'll probably get stuck here. So let me draw something else here. So I could say like it'll probably get here, get stuck, and then it'll just make a new low. It'll just start making a new low. It'll just keep going back down, and probably we'll be in big trouble into April. All right, tax season. So when people start paying the taxes last minute, it's probably will start taking out funds to pay for it. Then it'll move down. It'll move down probably to maybe 450. I don't know. Yeah, maybe we'll hit here. Maybe if it's bad enough, it can get lower. I don't know what would cause it to go that low though. So that's something to think about. Yeah, that's something to think about. Terrible. Let's see. This was like, it might just slice through this area. Yeah, okay. Okay. We'll see, guys. All right. But yeah, nothing. I don't think there'll be any big news that will know of until next week. So everything from here until the end of the month, it'll just be random noise. Maybe Trump will say something, Mexico will say something, Canada will say something, Europe will say something. Any of that could cause issues. But Powell, we're done with Powell. Bank of Japan, we're done with. Nothing else to say. It's just going to be a random shoot. And we'll have Max Payne. Oh, yeah. Another thing to talk about was Max Payne. Forgot about that almost. Let me bring that up. Max Payne. So I can remind you guys about Max Payne, which ends on Friday. All right. So let me close this stuff. Okay. All right. Okay. Alrighty, Max Payne. Let's see. Blah blah blah. All right. Okay. So Max Payne for the 21st. Is that correct? 2 days left. Yeah. Okay. So we're at 580 Max Payne. So right at that gamma flip level, right at it. So it's going to try to move towards it in the next day or two before expiration. So it'll try. Then on Monday, we'll see. It'll probably just go backwards. I don't know. Usually Mondays are not good after the expiration. So let's see how high it can go into 580 if it can even reach there. All right. So it's going to, right now we're 566. It's going to try to get to 580 for SPY. Now the other thing is the NASDAQ. Okay, Max Payne is 490. We're at 480. Okay, so watch 490 level. All right. And so compare that to the chart reading I just did for you guys. So it should come out the same way. You should see like why these places are important. It's because of options. And then the biggest option of them all from JP Morgan, the JPM collar trade refers to a JP Morgan hedge fund named JHEQX, which hedges a long equity portfolio using a large options collar trade. Each quarter, this hedge fund rolls to a news option collar trade, and the resulting hedging flows can often impact the market. To enter the collar, the fund sells a 3 to 5% out of the money call and use those proceeds to buy a 3 to 5% out of the money put spread. At the end of each quarter, they allow the existing collar trade to expire and enter into a new collar to cover their stock exposure for the following quarter. So this gets redone every quarter, and if it gets big enough, so many people use this ETF because they're so lazy, then yes, this will have a problem. So yeah, I think this is an ETF. You can get it yourself. Yeah. Okay. Oh, it's a mutual fund, so it's not an ETF yet. I'm sure one of these days they'll make a ETF equivalent of this thing. But yeah, if you got a mutual fund, yeah, you can use it. Let's see, down 3.5% year to date. Compare that to SPY. 3%, yeah. So the performance is about the same to a normal ETF. There we go. Okay, guys. I'm done. I'll see you guys. I don't think there'll be any new news, so I doubt I need to say anything unless there's some crazy shit happening. But we are it. And if you like this stuff, please like and subscribe to the channel. And we'll put up like the Cash App stuff here for you. Yeah, we're at 1.3K subs, and you can go to Porsche's Cash App at $PORSHAJAYE. Cash App, okay, and PayPal at PORSHA@jghb.info. You can also support us Streamlabs, streamlabs.com/TheUrbanLandord, and you can email me at crackcrack@jghb.info. All right, good night.
Feel like I should, feel like I should, feel like I should, feel like I should go. Go. Feel like I should go. Feel like I should, feel like I should, feel like I should, feel like I should go.